Hi guys, what is going on? It's Jake from Vantage Economics. Today this is very exciting. This is my first video that I'm creating for this new channel that I've set up. Vantage Economics, what's it all about? So I guess primarily I feel that at the moment within sort of the world of finance and financial markets, I do feel that there's lots going on and lots to be said, and therefore I found that I had a good opportunity to share some of my views, and I hope that it will be a channel that is informative, that people would learn, they'd watch the content and they might learn a thing or two, and that it would help them figure out their path on their journey also. So the first couple of episodes that I have planned, I'm going to do an episode on the stock market bubble, or why I believe that we do have a stock market bubble. So that should be interesting. And another episode I have planned is going to be all about quantitative easing, which is a very hot topic at the moment. Lots of people are talking about it. Some say it's going to be inflationary, some say it will be deflationary. And just for informative purposes, I wanted to share my thoughts and views on these things, which I hope you will find interesting. So without further ado, let's jump in to the first episode, which will be about the stock market bubble. Okay guys, welcome to episode 1, which I'm titling Financial Markets, the Bubble. Got my cup of tea with me, so you might hear me slurping that as we get through these slides. But yeah, I wanted to make these videos a little bit different to what I normally see on YouTube. I wanted to sort of have, obviously me talking, but slides in the background that would sort of help give it some visualization and help to explain things a little bit better. So the premise of this first episode is that I believe that the financial markets, and in particular the stock market, is actually in a bit of a bubble state. It's really overvalued. And so I want to sort of walk through this, sort of why that matters, why that's important, who's impacted by it. And then we can sort of turn that into some action points for us and how we might think about that and what impact that might have on, average Joe. So let's dive right into this then. So the first slide we've got is who owns the stock market. And I think before we dive into the bubble itself, it's really important to have an understanding of, who actually owns equities, who owns all these public companies that exist. Knowing that and understanding the demographics behind it can give us a lot of insight into sort of the way it behaves and why it behaves the way it does, and the consequences if it weren't to behave as it needs to. So what I've got here is a little chart that I've borrowed from Business Insider. So it says at the top, 84% of the US equity market is owned by households, mutual funds, pension funds, and foreign investors. And we can see that here, that's illustrated in this chart. So we've got households are at 34%, mutual funds at 23%, pensions at 12%, foreign investors at 15%, and then we've got some other smaller categories down here too. And bearing in mind this is just the US equities, but you can pretty much extrapolate this to any part of the world. It's going to be very similar. So firstly, looking at households then. Well, what are households? They own 34%, but what are they? So this ranges from high net worth individuals and family offices to average Joe investors who take advantage of apps such as Robinhood's or HL. So really, households are essentially just people like you or I. It might be a family that has a family office and they invest collectively. It might be an average Joe investor, perhaps someone a bit like myself. And these really are a very high, representing a high portion of total ownership of all the equities that exist. So I think at this point it's important to have a quick look at this fact down at the bottom of my slide, as this will really help us understand who are these people. It says that as of September 2019, the top 1% of Americans by wealth. So if you were to order everybody in a big ranking from the highest net worth individuals to the lowest, the top 1% of Americans by wealth control 56% of US equities owned by households. And we know that households own 30% of all equities. So really that makes it clear to us that actually, we call this category households, but essentially it is going to be very wealthy individuals, high net worth individuals, predominantly. Of course, there's some average Joes in there, but it's mostly going to be people with large amounts of capital that they've got spread into these financial assets. So let's move on then. That's the biggest factor. Let's quickly move on then. So pension funds making up 12% of total equity ownership. Pension funds are owned by workers from varying different backgrounds. Many people who do not directly hold equities will usually indirectly hold them within their pension fund. The fund is generally managed by their employer or the government. So, all workers, if you think about you or I, we have jobs, we work, we maybe get paid a salary, hopefully get paid a salary. As part of that arrangement, you will have typically a pension scheme, and there are different types of pension scheme, but broadly what we need to understand is that the money that you and I pay into our pension scheme, it does not just sit in a bank account somewhere. This money is taken by the pension provider and it is invested across all variety of different assets, and here we can see a large portion of those assets will be allocated to equities, to stocks and shares in real businesses. So they make up 12% here. But we're missing this large blue bit here, which is called mutual funds. So let's just read. It says mutual funds and ETFs are essentially ways to achieve diversification without huge amounts of capital. So when we think about mutual funds, really this is just essentially, if I were to invest $100 into a mutual fund, then that mutual fund would split my $100 into maybe even thousands of different subholdings. But if I was an average Joe investor and I've only got $100, I'm not going to be able to afford to own one share of every single business in the stock market. So whereas if I were to own the mutual funds, they can diversify for me because they're pooling with all sorts of other investors, and that collective effort means that they can diversify. So the important thing to note about these mutual funds and ETFs is, well, who owns those? Because they're not people, but the owners of the funds, again, it's going to be very similar apportionment to the rest of the equities. So who owns the funds? Well, the funds will be owned by households, again, high net worth individuals, average Joes, but also pensions. Pensions, they might not hold expressly mutual funds, but funds of some degree. It's a very common way of investing is to invest in a fund, achieving that diversification with smaller amounts of capital. So I guess what this graph really illustrates, and the point we want to draw from this, is who owns the stock market, who owns all of these equities, who is a stakeholder, who is interested in where the level of the stock market is, who's getting the returns that are being produced. And the answer to that question really is wealthy people with savings, people with excess capital that they can allocate, so high net worth individuals, average Joe individuals, maybe somebody a bit like myself. You have some savings, maybe perhaps you are a younger person, maybe you're saving towards your first home, maybe you own some stocks and shares, perhaps you have an ISA. That's a very popular way of investing, certainly in the UK at the moment. So average Joes, wealthy individuals, and also pension funds, which the difference between the pension fund and the individual investor is the pension fund makes the decisions on behalf of the individual. I have a pension plan, and I don't get to choose what I put it in. I mean, I can tick a box as to what level of risk I would like them to put it in, but I don't get to choose. That decision is out of my hands, and they invest the funds for me, which is a good thing because it's designed to save for retirement for everybody who's been working hard throughout their whole life. At one point, they're going to need to retire, and they're going to need to draw down on that capital that they've saved. and spend it to live. So we're starting to get a picture now of why it's so important that the stock market retains its value. These stakeholders, imagine if everyone's pension fund went to zero. We'd have a terrible crisis on our hands because people wouldn't be able to afford to live after they've retired. So those are just some thoughts about the demographic of the equity market, who owns it, who's interested in it, and these will help us understand the factors that drive it. Okay, so moving swiftly on then to indicators of a bubble. Remember I said the title of this episode is The Stock Market Bubble. So what are the indicators of a bubble? Why do I think we might have a bubble on our hands? Well, firstly, I want to say that all of these indicators, there are many reasons why the price of a share or stock will go up or down. I'm not saying that these items that I've identified are necessarily the only reason why stocks will move up and down, but I'm saying that these are indicators that we are in an overvalued market, the prices are too high, and that we're in this bubble situation. So firstly, low dividend yields. So what is a dividend yield? For those of you that might not know, a dividend yield is essentially the return you get from owning a share divided by the cost of buying that share. Think if you were to invest $100 into a company, you might expect to earn, say, $5 each year as a dividend payment from the company out of their profits to you. And that would be a 5% dividend yield. But let's read the facts. So the S&P 500, which is essentially one of the largest, or larger, might be the largest US index, the S&P 500 average yield is about 2%. So let's jump over to this graph here, and we're going to ignore the blue line. We're going to look at the orange line, which is the S&P 500 dividend yield against time. So if we look at the 80s, we're here down at 1979. You can see that the yields are sitting between sort of 5 and 6%. So if you were to invest $100 into the market, each year you would receive a dividend of $5 or $6. And then look what happens over time. So over time, into the 80s and into the 90s, you can see that the yields have shrunk. They've got smaller. And then they've hovered. They're hovering between 2 and about, well, that looks actually between about 1.5% and 2%. And then we see in 2009 this big spike up, which is of course due to the last economic collapse where equity prices shrank massively. And remember the formula, the dividend yield is the return, the dividend you receive divided by the price. If the price goes down, the yield goes up. So that's why we have a big spike in 2009, but then of course things correct, things go back to normal, as they seem to always do. And we're back hovering between 2 and 3% as of today's date. So let's carry on reading then. So the average yield is about 2%. Now this is 2%, I would say, in my opinion, is very low. When you make an investment in a company, that means that you take on an amount of risk. You're not just sort of putting your $100 into a stock or share and it's guaranteed to be worth $100 when you sell it. There's risk associated with investing. And what we see when we see a yield of only 2%, the risk and reward balance is very, in my opinion, unjust. It's very low. You're taking on all this risk of downside for only 2% upside. Now, I appreciate we're ignoring capital appreciation, but just focusing on the yield of the dividend alone, 2% is very low. Think about what is the lowest rate of borrowing you can do at the moment. It would be, when you go out and get a mortgage. And when you go out and get a mortgage, you might pay, say, 2 or 3%. So the bank is able to lend to you and make 3% at very tiny risk, almost no risk. Yet you put your money into the stock market and can only achieve a yield of 2%. So how come the bank is able to take this tiny risk and get more return than you are able to with your big risk. Of course, this is very generalized, and I'm not saying this is true for all loans or all equities, but it's just an observation that this yield is low. And we know this is low because it's been high in the past. It's been much higher. It's been between 5 and 6, which you might say is perhaps more healthy, perhaps more fair. So let's read then. The driver of low yield is either caused by lower than expected earnings or inflated share price. Inflated price is the main factor that is driving yields down, generally across all financial markets. So I guess it would be better to say inflated price is likely the main factor. But let's think about this. Investors choose to pay a certain price for a stock. If investors didn't like the 2% yield, if they looked at that and thought, you know what, it's too low, I don't accept it, then they wouldn't invest their money. They wouldn't buy that stock. And in response to the fall in demand for that stock, its share price would fall, you would think. And that would correct the yield. You see, the price would come down, the yield would go up, and it would become a more attractive investment once again. But no, the yields have stayed, ever since 2009, they've stayed. I mean, going back further than that, since the 90s, they've stayed very low, between sort of 2 and 3%. Yet people still invest their money in. They're not bothered. So again, I'm not saying that this is necessarily the only reason that stocks go up in value, but I would say this is an indicator of a bubble. Low yield is an indicator that we are in an overvalued market. So finally then, investors are happy to buy the stock knowing the yield is low. They don't care. They're not bothered. They're still going to buy it. Okay, so let's take a look at the next indicator of a bubble. So hype/FOMO. FOMO is fear of missing out. And this is a sort of behavior that we're really seeing a lot of at the moment, and particularly with the rise of popular trading apps such as Robinhood and Trading 212, Plus 500, etc. And it's all to do with hype and following the leader, and let's all pile into this equity, or let's all buy this stock, let's all just pile into that. And it really is based on hype, and people don't want to miss out on these great pumps that happen because people are just fleeing and running into these things without really considering any of the fundamentals. So let's look at for an example of this sort of hype and FOMO. I want to examine Tesla as a recent case study. So Tesla recently has been pumping very high. The stock price is very high. And we're going to look at some of the fundamentals and try and examine, do we think this is fair? Is the price fair? So Tesla's market cap dwarfs automobile giants. Market capitalization of publicly traded car manufacturers as of September 1st, 2020. So for those of you that might not understand some of that terminology, the market cap of a business is simply the number of shares in issue multiplied by the market value per share. Say I had 500 shares in issue with a market value of £1,000 per share. My total market cap would be £500,000. And this really paints a picture of the total value of the business. What is the business worth? The whole business. So that's what we get by looking at this statistic called market cap. So look at Tesla as well, $443 billion. And if we go to the next one down, we see Toyota, which is, Toyota's a very well-known brand. They've got considerable past performance. They've sold cars for years and years and years. Household brand. Many people have probably owned a Toyota at some point in their life. Look at this, 185. So it's less, in fact, much less than half of the market cap of the value of Tesla is Toyota. And we sort of go down. We've got the Volkswagen Group, Daimler there. That's Mercedes, I believe. BMW, Honda, General Motors, they're all worth way less than Tesla is. Tesla is way hyped. Okay, so let's take a look at some of the points that we've got to make about this. So Tesla market cap is 440 billion, representing a huge portion of the new car market. And we can see that just from the table, looking at the illustrative graph. Look at it, the bar is just enormous. You know, it dwarfs all of these other huge, well-known brands. And I want to go to an interesting point on their financials. So, you know, what's the reality? What's the substance of their financial performance? So based on the 2020 quarter 2 results, the 2020 earnings yield will be roughly 0.125%. So this is very low. This is the first profit they've ever made, and it's a very small profit. I understand it's the first profit, correct me if I'm wrong, but that's as far as I'm aware. They've only just announced that they've made a profit. And, you know, think about it. They've got to recoup all of the losses that they've made over the years to get to this level before they can even think about, you know, distributing these profits out back to shareholders. So the performance is not there yet. So all of this bet is just speculation on the future. But let's think about that. So this last comment then. At the current valuation, you are betting that Tesla will sell about 1.7 times as many cars per year as the big 4 German manufacturers combined. So that's your Volkswagen, your Mercedes, BMW and Audi, all combined. Tesla are going to sell nearly 2 times as many cars as these guys. And I appreciate the market cap figure for Audi is not shown on this graph, but I've just plucked it from another website. These are very ballpark figures as well, but you can see the disparity. You know, they're really taking a punt. Everyone's going to have a Tesla, and I think whilst I do believe it can grow, they can grow from where they are. You know, just think logically. How often, when you change your car, do you buy the exact same make and model as the one you just had? Quite often, people want to get a new car. They sell their Ford and they buy a Vauxhall or something like that. You know, people tend to change their taste. They want something new, and that's why we have so many brands. There's so many brands in this industry, brands that are similar as well. A lot of competition, so that there's an awful lot of competition out there, and I just find it quite remarkable that people believe that it's going to grow to be, it's going to just completely overshadow the big German manufacturers. And we will see if this comes true. I could be completely wrong, but the point I'm trying to make is this is a very significant punt, and when there's no real financials behind the valuation, it's simply a purely speculative investment, and one that I'm not making. So yeah, there's lots to consider here. This is the sort of environment we're in. People are diving into these stocks, and just because everyone else is, and it creates a bubble. Okay, guys, on to my third indicator. Just had a couple of swigs of tea. So, okay, let's have a look at this one then. Indicators of a bubble: irrational price action, irrational behavior in asset prices. We are in a major recession, yet asset prices are not following the trend of economic reality. So, friends, I don't have to tell you about the COVID, the coronavirus. We all know about that, right? And the impact that it's had on the economy. There's this huge crash in the economy. So what does the stock market do? Well, let's take a look. We've got two graphs here. So here we have the UK monthly GDP index. And we can see since 98, growth, 2020, COVID, crash. And the headline with that one was 18 years of growth wiped out in 2 months. 18 years. This is a huge crash. This is enormous. You would think, goodness me, this is a problem. Let's take a look at the stock market now. I appreciate here I've got the S&P graph to make my point now. This is a US market. It's not the UK, but we know there's been contraction in GDP in the US as well, so it's a very similar story. But look what's happened along the same sort of time frame. We go up and up and up in value. Stock prices go up and up and up. Crash because of COVID. And then suddenly, up and up and up and up again. As if it never happened. And you think, how on earth have they done that? They've crashed, one of the biggest crashes we've ever seen in all of history. And a couple of months later, whoop, there we go again. Something is going on. And friends, thinking back to 2008, 2009, the market took a lot longer than just a couple of months to completely recover. So this is very strange and doesn't feel quite right. So let's take a look now at some of the comments we've got then. So we are in a major recession, yet asset prices are not following the trend of economic reality. This divergence between reality and the prices. During a recession, the risk of investing in equities is much higher. Companies are at much higher risk of failure due to bad performance. So let's look at some particulars then. Revenues are stifled in a weak economy. So in a weak economy, people are spending less, they're going to the shops less, they're doing leisure activities less, and that's going to result in less revenue on the top line of the business, and that's going to stifle profits, stifle cash flows, stifle performance, and that should really result in these companies becoming less profitable and therefore less attractive as investments, and therefore their price in a rational way should fall in response to this. Instead, we see the increase. So what else? We've got debts. Debts will increase during a recession. Think about it. What was one of the UK government's first ideas? When this all started to happen, they said, right, well, we're going to give loans. We're going to give loans. We're going to give loans to small businesses. We're going to give loans to big businesses. We're going to give everyone loans. And friends, debt is a short-term solution to these problems. You can pile a company up with debt to fix the hole in the revenue, to fix the hole in the cash flow. But you've lumbered it with this burden, this debt. And as we know, companies are very indebted already. There's a lot of debts, corporate debts, floating around in these big businesses as it is. So to lumber them up with even more, it's just going to create more interest costs that they need to service, more capital repayments that are going to have to be saved up for and paid off one day. And it's just not good. It's going to have a negative impact on financial performance, and therefore should have a negative impact on the market value of these stocks, because they are becoming less profitable to own. Okay then guys, finally I want to talk about what are the consequences of a stock market bubble. So large amounts of wealth are stored within the financial markets. Many stakeholders have a direct interest in the preservation of the stock market. So when we think about that first graph that we looked at, who owns the stock market? Who are the stakeholders? What are they concerned about? And for those that are part of it, they're part of the bubble. They want it to continue. We want to see this carry on. We want to see prices rise and rise and rise indefinitely. And many of the stakeholders in the market are very influential businesses, organisations, persons, and they've got the clout to be able to make this sort of thing carry on. So that's certainly worth thinking about when we think about how it might behave in the future. Who are the stakeholders? Who's interested in this? Let's have a look then. Governments are preserving market strength by methods such as QE, quantitative easing. These are not sustainable methods and will have long-term implications on the economy. So a bit to do with the first point, the maintenance of these markets is so crucial to public opinion of the government, to people's livelihoods, their pensions, the value of their pensions, wealthy, influential people, the value of their wealth, the things that they own. All of these pressures are applied, and the government has to respond. And the government, since coronavirus, and has done so in the past as well, has taken up a method called quantitative easing. I'm going to do another video on this because I think it's a very important topic to understand the implications of it. I'm not going to dive into detail now, but just understand that the government is now taking steps to try and preserve the integrity of the market values. And this will have implications. So let's carry on then to the last point then. Long term, there are two paths the bubble can follow. Either there will be a large correction to the downside, or the market will inflate to infinity, as it always has done. So friends, some say, the stock market always goes up, it never comes down. It sometimes comes down, but it'll always go back up. And really, I do think these are the two options. It might seem obvious, but it's either going to correct significantly back to a more healthy level, or it's going to just inflate and inflate and inflate and blow up and be a never-ending balloon of wealth. So these again are things that we need to consider when we're thinking about our savings. Maybe I've mentioned already, if some of you are maybe looking to save up for a first home or something like that, and you're being encouraged to look at opportunities in maybe a stocks and shares ISA or something. These are important things to think about. Where is the market at? What's the risk involved? What's going to happen? Are my savings safe? Will they be preserved? These are the questions we need to be thinking about and asking about when we want to make sensible and wise decisions. Finally then, very briefly then, so what are the opportunities? And these are some of the topics that I'm going to be talking about on my channel. Some of the, with all the risk and the bubble and the scariness that's going on, equally, there's always opportunities that come out of the other end. So I'm going to be talking about just a handful of things. So opportunities in the stock market, where I think there might be potential to take advantage of different stocks that are out there. And then opportunities in inflation hedge assets, so things such as gold, or even new markets such as crypto and Bitcoin and things like this. So yeah, I'm looking forward to discussing these things in more detail in future episodes. I hope you found this presentation informative. I hope it was useful and that you'll take away some of the things and research it for yourself. Research and see, are these things true? Are we in a bubble? Is this true? And then hopefully that will gear you up as an individual to make your own sound and sensible and wise decisions about your finances. And I hope that you will tune in future episodes, and feel free to contact me. I will leave ways you can contact me in the description below, and I'd love to get in touch and chat with you guys. And thank you for watching, so take care.